Scalping trading might seem like a fast, easy way to make money. Place a trade at high leverage, aim for a few pips, and collect your reward. Sounds doable, until you lose a couple of times in a row, and find that your losses are much bigger than your wins. Scalping seems fun when you're winning, but as soon as you start losing, it's not fun anymore. So if you want to scalp the market successfully, you should consider following these rules to improve your odds of succeeding. First, minimize the use of indicators. All trading platforms will have a lot of indicators and oscillators. As a trader, you would want to double-check every trade before placing it, so it would be tempting to add as many indicators as you can, and then you will end up with a cluttered workspace filled with indicators. This is never advisable for any kind of trader, but when you're scalping the market, this could end your trading career very quickly. As a scalper, you want to catch any minor trends or shifts in the market, which means you need to make quick decisions. As much as indicators are useful, having too many of them will cause an overload of information. And before you can place a trade after interpreting every single indicator, the price move you were looking for will be gone. Beginner scalpers always love to trade with lots of indicators. They think this is the best way to find great trades. They overload their charts with too many indicators, with the hope to find the best possible trade setup. But when you take readings from too many tools, it's really hard to predict the price movement of a certain asset, especially on lower time frames. You need to have one or two indicators which you have tried and tested, and put your faith into those. Do not second guess yourself by adding on more indicators to your workspace. Second rule: don't marry a position. From a trading perspective, marrying a position means a trader has become emotionally attached to holding it, especially in the face of strong evidence that this is not the right position to be in. This particular trading error can often result in excessive losses and wasted margin because a transaction intended to be a scalping trade can turn into a day trading position, or even worse, a swing trading one if you trade without stop-loss orders. Successful scalpers generally avoid getting emotionally involved with holding a particular position, especially when the market is clearly telling them they are on the wrong side. This is especially true if you make the mistake of not using stop-loss orders or using mental stops. Number 3. Avoid over-trading. One of the biggest obstacles standing in the way of amateur traders becoming professionals is their lack of recognition and acceptance of the fact that trading less frequently